Good morning. It's Tuesday, the 9th of September, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital. We've got a packed show today. Our top stories and themes. The stock markets fail to hold on to gains, but steel and auto stocks do well. India is set to outstrip China in oil demand. Gold hits a fresh high. Quick reminder, bullion is up 38% this year. How auto dealers are happy tax rates are down, but they want to be compensated for higher priced inventory. Why foreign investors are selling for more than a decade now, and the story from 1998 to 2016, a deep dive discussion. And how Tesla's US market share has hit a 8-year low.
This is a call report with Govindraj Ethiraj.
A band of uncertainty. The stock markets continue to move in a broad band of uncertainty on Monday, which was somewhat expected going in. They opened strong on Monday morning, but lost most of their gains, though closed in the positive. The BSE Sensex hit an intraday high of 81,171, but closed up 76 points at 80,787. The NSE Nifty 50 was up 32 points to close at 24,773. The Nifty Mid-Cap 100 and the Nifty Small-Cap 100 were also up slightly, 0.5% and 0.16%. So auto stocks continue to do well, including ancillary companies. Shares of steel companies also continue to rise. Basis reports the government was preparing a national mission with a proposed outlay of 5,000 crore rupees to promote sustainable steel production. There were other reports which suggested that China would cut steel production in 2025, according to a report in Business Standard, which added that Tata Steel hit a 52-week high, and then stocks of Steel Authority, JSW Steel, and Jindal Steel and Power were also up beyond the market. Sector-specific news clearly appears to be lifting stock prices, as we saw on automotive stocks as well, thanks to the expected impetus from tax cuts on cars and two-wheelers, and more on all of that shortly. Meanwhile, even more supply is on the way. South Korea's LG Electronics is looking to launch its maiden IPO, or initial public offer, in October. It plans to sell about 15% of its stake, and that will be worth about 15,000 crore rupees. And that would make it, as things stand, the largest IPO of 2025, according to a report in Business Standard. And then on Wall Street, stock markets were looking to start on an upbeat note ahead of inflation and jobs data that could influence how fast the Federal Reserve lowers interest rates this year, according to the Wall Street Journal, which added that the rate cut next week is viewed as a virtual certainty following August's lousy jobs report. Elsewhere, oil demand growth in India looks set to outpace China's underlying gains this year, according to a Bloomberg report quoting Trafigura Group, adding that this year Indian demand is set to outstrip China if you exclude strategic stockpiling. China is seeing slowing crude consumption growth aside from in petrochemicals. Going into next year, there are also fewer clear drivers for global demand, analysts said, even as more supply comes into the market, making it difficult to see how the extra oil will be soaked up, according to that report. All the analysts were speaking at the Asia Pacific Petroleum Conference, or APEC, by S&P Global Commodity Insights, and that's going on in Singapore. Is there enough demand to absorb this? An analyst asked. We're talking about next year just under 1 million barrels a day of demand growth. Unless you're talking about double that just on the demand side, it's tough to see. Elsewhere, demand continues to be strong for gold prices, which continue to rise. Gold went past the $3,600 per ounce level for the first time on Monday after soft U.S. jobs data increased expectations of an interest rate cut by the U.S. Federal Reserve next week. According to a Reuters report, spot gold was up about 0.9% to $3,617 per ounce, and bullion hit a record high of $3,622 earlier in the session. Now, bullion is up 38% this year, and that is atop a 27% gain in 2024. The reasons range from a weak dollar to strong central bank buying, which we've discussed before, a soft monetary policy backdrop, and then, of course, the most important, geopolitical and economic uncertainty. Meanwhile, in the sign of times to come, China's exports to the United States fell 33% in August, while overall growth slowed to its weakest in 6 months. Remember, exporters would have and have front-loaded their exports in anticipation of higher tariffs, and therefore we could be seeing an adjustment there. Imports from the US also dropped 16% from a year ago, according to customs data quoted by CNBC. And here's a message from a sponsor. Want smarter investing at your fingertips? With InvestingPro, get real-time market data, custom alerts, and global financial insights all in one place. Join 46 million users already making sharper decisions. Download InvestingPro today. More details in the link below. Car sales. The Federation of Automobile Dealers Associations, or FADA, has written to the government to seek clarifications on the Goods and Services Tax 2.0 that was announced last week that subsumes the earlier compensation cess regime for automobiles. FADA said in a letter dated September 5th that dealers today hold significant, validly availed compensation cess balances in their electronic credit ledgers. Once no further cess liability arises, these balances cannot be utilized against CGST, SGST, or IGST, that's Central Goods and Services Tax, State and Integrated Goods and Services Tax under the current law. FADA has requested the government to transfer the balance lying in compensation cess credit ledger by September 21st to their Integrated Goods Services Tax and Central Goods and Services Tax credit ledger so that their festive sales are not impacted. Now, I know this is sounding a little complicated, so hold on. According to dealers, there could be an estimated cess loss of about 2,500 crore rupees to them. So Goods and Services Tax has come down for auto from 28 to 18%, but there are a lot of other adjustments and the cess levels vary. I reached out to CS Vigneshwar, president of the Federation, and I began by asking him how, firstly, the last month has been, particularly after the Prime Minister's August 15th announcement of a GST rate cut, which in turn led to many buyers holding back their purchases.
Well, we've been advocating a rationalization of the GST for quite a while, and even very recently we wrote a letter requesting for a rationalization. What came in on the 15th of August was a bolt out of the blue. I mean, it was absolutely a surprise, and it was much welcomed because we really require lower taxes for us to aid consumption and consumer behavior in a positive way. So that happened. It was just announced on the 15th, and then the clarity came in about a few days back. I think it's fantastic for the economy. The bounce you're going to see from in terms of customer spending, the money circulation, it's really going to help because we are already seeing a jump in customer interest. So even after the announcement on the 15th, we had a lot of inquiries, a lot of showroom walk-ins come in. And of course, we thought that the month of August would be worse because a lot of them are postponing the purchase. But actually, we came away relatively unscathed. We grew at about 2.5 to 3% overall across various verticals, which was good. And there were fantastic growth in Kerala because of Onam and because of Ganesh Chaturthi. Also, Maharashtra had excellent run compared to the rest of the nation, of course. But when you look at it, I think it's fantastic. I think it's somewhere where all the states and the center came together on a common note. And they decided unanimously that this is needed for the economy. It's a path-breaking reform. I think from a very complex structure, at least for dealerships, it has become a lot more simpler because we used to have different kind of cesses along with GSTs.
So I'll come to the cess in a moment, Vignesh. But so you're saying that despite the fact that there was a promise of rates coming down only later, and which is now September 22nd, we still have some time to go. You're saying that people did not really hold back on purchases, or is it a different kind of purchases that we saw in value terms?
Perhaps we would have seen a little bit more purchase had the announcement not come, but at least it wasn't a degrowth in terms of year. So it was quite strong then.
And is there any category that saw more purchases as opposed to any other shifts in patterns, or was it the same as, let's say, the month before? Or
it's very similar to the month before. Overall, as I said, we had decent growth. Overall, it was quite good, even in terms of tractor market. The tractor market actually grew by about 30%. Look at passenger vehicles was about 1%. Two-wheelers were about 2.18%. We also had commercial vehicles, which showed 8.55%, which is again a decent growth. So there were pretty much growth throughout the particles. So it was quite good that way.
Got it. Okay, now let me come to the compensation cess. I mean, if maybe let's try a simpler version of it. So the tax that you're paying when you're buying the vehicles into your dealerships is obviously now more than what you will get from the consumers from September 22nd onwards. So how is that play out?
So there are two components here. One is the GST portion of it and one is the cess portion of it. The GST portion will get adjusted over time. I thought that was a headache, but now cess has become a bigger headache. So
So can you just walk us through, like, suppose if it was a 10 lakh car, how it would work?
So the simple thing is there is two components to it. One is the cess. For the highest amount of cess, let's say charged to an Innova Crista is about 22%. So the overall came to about 50%. And when you look at it, the GST charge was 28%. So the rest, 22%, was actually cess. So what the government has said is the GST component, which is 28%, which has gone to 18%, which has gone to 40% in this case. It's actually the other way around. We quickly claim credit for it. But the issue is the 22% which the government said to charge as cess. At the end of the day, the cess was supposed to be paid by the end customer, not by the middleman. Dealer, I'm a distributor. I should not pay that cess. So the concept of the act doesn't make sense, given the fact that they said that on the 22nd, the cess would go away. And go away, that means I need to absorb it into my books and I need to write it off. We are a high value product industry, so we just can't write off cess that way, which is going to lead to huge amount of losses. And honestly speaking, we can't do losses. It is amounting to more than 2,500 crores for us as dealership stocks. We as an industry can't take this.
So this is money that you have paid manufacturers, who in turn have paid the government, or what's the normal chain?
Yeah, so that's how it goes. I pay the government. The cess goes to the government. So the issue is that money is still with the government. So the government needs to consider how they give it back to us. Otherwise, I can't go and charge my customer here. So it's a very sad situation, but we have highlighted to the government. Perhaps they also have promised to have a look at it. Our Honorable Finance Minister, Nirmala Sitharaman ji, has stated that there will be some kind of an interim measure. I read in a paper where she gave an interview. And we've also been approaching the various government ministries who are connected with this. And they have to get back to us, but hopefully we can engage them and make them understand.
And you're saying this is not as simple as a book entry between, let's say, the cess account to a GST account?
They said it's not possible. They can't do that. So given the current rules, the box is this small. So probably they enlarge the box for even the bureaucrats to take decisions. Today, the bureaucracy is giving answers saying that it can't be done because that's the box. So we need to largen the size of the box and see whether it's fair to leave us burdened with this cess which was supposed to be paid by the end customer.
And this is really the cost that dealerships like you have incurred in this period from the date, which is last week, to today, and will incur till September 22nd.
We don't know if the government is going to. You're talking about the interest component of it, but I'm also talking about the whole principle of it, the whole principal component of the 2022. It sometimes for some vehicles is 1%, for some vehicles a component of cess is 22%. So I don't think it's fair when we are left to burden the cess.
Correct. And when it comes to consumers, people who've, let's say, booked cars or four-wheelers in the last 10 days, 15 days, and still not got delivery, where do they stand?
So a lot of companies are already offering discounts which would match the new tax rate after the 22nd. I think it's a fantastic deal. It'll be better if the customers go and grab it right now, because during festive season, the peak festive season, definitely we won't have the vehicles to give you. The color, your suffix, the version of it, we may not have stock to give it to you. But it's great that a lot of companies have come forward and said, we'll give you the same rates right now. Please go and take your vehicles right now. I think it's a fair thing to do, because definitely we're not going to take any more stock as the dealers, because you take any more stock as before the 22nd, we don't want to be burdened with more cess issues. So that being the case, there's only a limited amount of stock for the first day of Navaratri. Grab your vehicle right now. The vehicles are being offered at rates which you're going to get after the reduction of GST. So it's a good time for the customer to go and shop.
So who's taking the haircut here then? If the consumer is getting it at a price which is post September 22nd price?
I think some cost of it, the burden has been taken by the manufacturer, and some of it is taken by the dealer. But at the end of the day, the manufacturer has a bigger role to play, because as FADA, we've been screaming out aloud for the last year and a half, we are overstocked. We are saying 21 days of stock is more than enough to serve the customer. But a lot of manufacturers are taking the stock to for an average of 55 days, 56 days right now. Some of them are 30 days, some of them are 50 days, some of them are even higher. So the onus is right now with the manufacturers. We've said, I don't want this stock, but we've been pushed the stock by manufacturers on us. So the majority of the stock is because of their doing. And therefore, they also have the responsibility of liquidating stock and the stress which is accumulated because of higher stock.
Got it. Last question, Vignesh. So beyond September 23rd, how are you seeing this festival season, particularly compared to last year?
I think it's going to be great. The economy has been doing well in general. Our markets, we predicted the two-wheeler industry to grow up in the slightly higher single digits. The commercial vehicle might be flat, is what we commented. And the four-wheeler industry will be probably growing in the lower single digits. I think all of it has come true except the two-wheeler, which has been much lesser than predicted. But having this new tax structure is going to really buoy demand, get people over to our showrooms and give us an opportunity to sell them a vehicle of their choice.
Great to hear. All the best for the festive season, Vignesh. Thank you so much for joining me.
Thank you.
Meanwhile, India's Commerce Minister has joined the Finance Minister in exhorting industry to pass on the tax cuts to consumers. He said that it must be ensured that goods and service tax reduction reaches consumers, which in turn will strengthen industry and trade. Tesla's woes. Sticking to cars, and another sign of how nothing is permanent or even close to it, Tesla's US market share has now dropped to a near 8-year low in August, even as buyers switch to rival models against an aging lineup from Tesla, according to Reuters, which quoted data from research firm Cox Automotive. Can you imagine Tesla's lineup being called aging? The decline highlights the threat from automakers who are ramping up electric vehicle incentives at a difficult time for industry. Analysts expect, says Reuters, an EV sales bump to continue through September in the United States and then drop when federal tax credits expire at the end of the month, which raises financial pressure on Tesla and other auto companies. Now, here's the interesting part. Tesla once held more than 80% of the US electric vehicle market and now accounted for only 38% in August. And this is the first time that has fallen below the 40% mark since October 2017, when it was ramping up production of the Model 3, its first mass market car, according to data from Cox, quoted by Reuters. Tesla, of course, as we've been discussing, has turned its focus to building robo-taxis and humanoid robots, and also using that as a pitch for more value and valuation in its company. And much of that Tesla's trillion-dollar valuation hangs on that bet. And by the way, the company on Friday proposed an unprecedented $1 trillion pay package for Musk, apart from other operational milestones, which expect to Tesla's value rising to $8.5 trillion over the next decade. Now, the value, of course, is notional, but the pay package is more real, I would imagine. And at $1 trillion, that's about 1/4 of India's current GDP. The long road to FII sales. Why are foreign institutional investors selling now for more than a decade? And looking back, how long did the emerging market boom really last? Now, the reasons and the background is quite interesting, and so are the timelines. And some recent history can be quite illustrative. At the Elara India Dialogues for 2025 in Mumbai last week, I spoke with Adam Wolfe, emerging market economist at London-based Absolute Strategy Research. Wolfe has covered China and other emerging markets for over 15 years and has also contributed to the US-China Economic and Security Review Congressional Commission. I began by asking him what has happened, or rather what happened after that sustained growth phase that emerging markets saw between 1998 and 2016, and whether there's any hope of things returning to what they were.
I think the big turning point has been the big structural factor holding back our emerging markets over the past 10 years or so has been the dollar. The dollar has been appreciating a broad basket of other currencies. And typically what you see is when the dollar appreciates like it has over the past 10 years, that leads to bad events in emerging markets. And this time around, it's really just led to kind of doldrums growth in emerging markets, where that the growth differential between emerging markets, excluding China, because it's kind of a separate thing now, and developed markets narrowed from about 3-4 percentage points down to, well, just about nothing really in 2020. But even that kind of outcome is better than what we would expect in previous dollar cycles. If you think back to the early 1980s or the mid 1990s into the early 2000s, you saw a number of emerging market financial and debt crises at the end of those dollar cycles. And this time around, we saw a few of those, but just in kind of smaller frontier markets. And most emerging markets actually have managed that appreciation of the dollar much better, but still had these headwinds for economic growth that comes from that.
And what explains, for someone who's trying to understand, what explains this sustained rise in the dollar itself?
So I think typically what's driven that in the past which is a little bit different this cycle, is that you've seen aggressive monetary tightening in the US, and that's sucked capital out of the rest of the world back into the US. This time around was a little bit different in the sense that a lot of it was coming from just very strong earnings growth in the equity market from a very small portion of that market. And also somewhat less aggressive monetary easing relative to other developed markets. So the bond US treasuries were still attractive for investors in Europe and Japan, for example, and that pulled money into the US and leading to the appreciation of the dollar.
And when we look at emerging market flows from the West, now it's not only the United States. The dollar is the defining currency, but it's also coming from other countries, including in Europe. But you're saying that really it's the dollar which is determining where money will go, not from where it's coming.
Right. I think because the international financial system, by and large, is a dollar-based system. And so no matter where you sit, it's kind of dollar funding costs that determine the overall kind of funding flows for the rest of the global economy. And so where the dollar goes, by and large, the rest of the world kind of moves in that direction as well.
So if, let's say, big funds, including endowments and long-term pension funds, I mean, they're the kind who also invest in large amounts for long periods of time in emerging markets or have invested. If they've not been investing so much in emerging markets in this period, particularly, let's say, after 2016, so where have they been putting their money?
A lot of the money has gone to the US. I mean, you can see the flows into US treasuries, which is really just an alternative compared to, they've looked more attractive to European bonds that they might have added to those portfolios. But a lot of that has gone into the US equity market. And you can kind of see the concentration of that into the US, and you see the outperformance in terms of valuations as well. And that's been driven partly by earnings growth, but that earnings growth has attracted those flows and bid up the price of those stocks.
Say we are in the cycle today. I mean, are we sort of plateauing? Is it still going downwards? I'm talking with the flows because the dollar, of course, has weakened, and I'll come to that in a moment.
In terms of the flows, it doesn't look like anything has changed dramatically so far. So we saw this blip in April when the first round of tariffs came from the US, and you saw US Treasury yields spiking while the dollar was depreciating, and that kind of led to some outflows. But that's since reversed, and you're still seeing flows going back into the US. I think the difference since April has been a larger portion of those flows have been hedged, currency hedged. And that's kind of led to this decoupling between treasury yields and the dollar that you typically don't see.
And if I were to now come back, I mean, what's the outlook here on? I mean, if we were to look now, it's been more than 6 months of tariff tantrums. The uncertainty seems to have been absorbed by all or most markets, though the economic damage, I suspect, will be felt much later or for longer. So which way could flows go?
I think that we're probably nearing a tipping point in terms of flows and for the dollar itself. A simple way to put it would be that global investors are over-indexed to the US at this point. New questions emerging about the safety of those investments for political reasons, but also for reasons of just market concentration that really it's 6 stocks driving most of the US market at this point. And the dollar is really overvalued by almost any metric right now. And currencies do tend to mean revert over time back to their fair value. And so you have that kind of valuation and the catalyst to push it in that direction. So I think we're probably nearing this tipping point where we should be in more of a structural bear phase for the dollar. And that bear phase will mean net outflows from the US to the rest of the world.
And what's your sense about emerging market risk appetite right now? So again, if you were to keep dollar aside for a moment, I know you can't do that, but if you were to for a moment, I mean, investors spend time and effort trying to understand, identify stocks in emerging markets because they saw long-term growth potential, higher alpha, and so on. While that may be sort of being counterbalanced by the strong dollar all this while, I would imagine that there is still risk appetite. Or, well, let me put the question differently. What's your sense of that risk appetite when it comes to emerging market equities?
So we haven't seen big flows into emerging market equities so far. And I think that global risk sentiment towards emerging markets is still somewhat cautious. I think that the economics look relatively positive, or have looked relatively positive so far. So you see that real GDP growth differential widening back out between emerging markets and developed markets, which is really the thesis of investing in emerging markets, is that they should grow faster than developed markets. And so that thesis is being reflected in the real data again. So that should be pushing flows in. I think that the volatility in U.S. politics and what that's meant for the global economy has left people a bit more cautious. And so while there are concerns about the riskiness of U.S. assets, that's not going into even riskier assets. It's going into close alternatives for other safe assets. So gold has done very well as a result of that because in terms of the risk spectrum, it's closer towards a treasury than a EM bond would be necessarily.
And if you were to look at, let's say, the rest of 2025, how are you seeing the overall behavior of the dollar versus flows once again?
I think as things start to settle down and economic fundamentals become more important, that we should start to see more flows going into emerging markets and going in further out on the risk spectrum in non-US assets. And emerging markets will benefit from that as well. I think Europe also looks attractive since some of the flows will go into Europe and EMs might not absorb the bulk of those flows. It might be a smaller portion, but it'll be a net positive compared to what emerging markets have seen over the previous 10 years.
And I mean, I don't know if you've done any sort of early studies on what the impact of tariffs are going to be, but what's your sense? I mean, not so much linked to investing in equities, but what's your sense in terms of the economic harm, or if so?
So I think for most emerging markets, this is an absorbable hit, that it's half a percentage point off of GDP growth or something like that. And for a country like India that's growing 7.5%, that probably doesn't even get noticed. For some other countries, the hit might be a bit larger. For smaller, more open economies, the hit will be larger. But in the aggregate, it's going to knock a little bit off of GDP growth, but not really disrupt that growth pattern over the medium term. And I think that there are some offsetting benefits for emerging markets. One would be the dollar itself. If it were to depreciate, because most global trade is invoiced in dollars, that means that imports become cheaper for the rest of the world in local currency terms, and that tends to boost the volume of global trade overall. And that can offset some of the impact of the higher tariffs in the US, which will drag down, about 15% of global imports come from the US. That is a meaningful headwind. But if the other 85% is growing faster, that absorbs some of that impact.
And what's your sense on now all the other major countries, China, Russia, India, for example, have just got together. There's an attempt to present a unified front of sorts against the United States in the tariff context. What could this lead to? It could lead to not much, but if it could lead to something, what could it be? I mean, as a macroeconomist.
Yeah, I mean, there are a number of outcomes that this can lead to. So I think on the most extreme would be a real economic and financial and closer financial integration between the economies and moving away from this international dollar payment system, trying to settle more trade in local currency, for example. Or the easiest thing would be to settle more trade in Chinese renminbi because the international payment system exists already as an alternative to the international dollar payment system. And so we can see more of that trend. And you are seeing Chinese banks lending more aggressively abroad in renminbi rather than dollars they have done traditionally. And that can kind of push a portion of emerging market activity into a different system that would have behaved differently from this kind of global dollar cycle that we've been talking about. I do think that South-South trade has been a growing portion of most emerging markets' export baskets. And so the BRICS, broadly defined, trade more with other BRIC countries than they do with the US and US allies, and kind of NATO, broadly defined, plus Japan and Australia. And that trend will continue, and that also makes them a bit more insulated from kind of the cycles in developed markets. I think what's difficult is that South-South trade can't be a direct replacement necessarily for US imports, because the products that India exports to the US, for example, only about a third of that export basket overlaps with the export basket of what it exports to the other emerging markets. And so it would require a more aggressive retooling of the economies that seems unlikely in the short run. But it's a helpful offset, but it's not a direct kind of one-for-one replacement.
Last question. So, I mean, when you get up in the morning, what's the metric that you usually look at to see where the world's at from your vantage point?
Well, I mean, I think that the two most important variables for financial markets are really the dollar, trade-weighted dollar, and where the U.S. 10-year Treasury yield is. And that helps to determine where everything else is going to flow. Because I do think that the dollar cycle really is the dominant financial cycle for the global economy.
Right. Adam, pleasure speaking with you. Thank you so much.
Thank you for having me.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.